The top business stories live from the Sky News City studio. The Bank of England says inflation could fall to its 2% target within a few months as it keeps interest rates on hold again. Volvo Cars says it will stop funding its electric vehicle startup Polestar as it reports record sales and profits. Plus, I'll be joined by the Chief Executive of Phoenix Group as the UK's biggest long-term savings and retirement business hits a crucial cash generation target 2 years early. Good afternoon, this is Business Live with me, Ian King. Well, as expected, the Bank of England's Monetary Policy Committee kept the main policy rate unchanged today at 5.25%. But talk is now about when a cut might come, with the markets now suggesting it will be May or June as the inflation nears its 2% target. However, the bank also warned that inflation may rise again somewhat later in the year. Well, joining me now is our economics editor, Ed Conway. Ed, I thought it was quite a hawkish statement overall from the bank today.
Well, I mean, in some senses it was, because it wasn't, saying, we're going to cut rates at this point. And obviously there were still two people within the bank's 9-person Monetary Policy Committee still voting for increased interest rates. But by the same token, and Ian, as well as I do, there's lots of kind of Kremlinology about this, people watching, looking at various different signs for the bank, trying to get a sense of where they're going. Because behind the scenes, they may have just left interest rates on hold, but there is stuff going on. They're kind of readying the ground for what many people see as the inevitable set of cuts. What's quite interesting, I've just come back from the bank just now and I was talking to the governor, and we asked him throughout the press conference just to try and give a sense of whether the next move in interest rates was more likely to be up or down. And, there's a reason for that. Only in their last statement, so 3 months ago, or indeed their last minutes, which is more recently than that, they were still saying that the next move was more likely to be up than down. Well, finally, in the interview that I did with the governor, he finally said that he thinks the next move is more likely to be a cut than a rise, which is kind of one of those moments, actually, because it's preparing the ground for whenever that cut will come. And as you say, markets now pricing that in for maybe May, some think it will be June, but quite soon. With interest rates at 5.25%, the expectation is they get down towards kind of close to 3% within a couple of years. So we are kind of moving towards that moment. You've just got this strange feeling, though, of all of these central banks around the world. So you had the Federal Reserve talking about this yesterday, you've got the European Central Bank as well. Everyone is kind of aware that at some point they're going to have to start cutting interest rates. Inflation's coming down faster than expected. The economy is looking much weaker right now than a lot of people would like it to be. And you look at those bank forecasts today, they're basically saying there's going to be a recession if you leave interest rates where they are right now. So everyone is kind of waiting for that moment. But everyone, by the same token, is a bit nervous about dipping their toes into the pond first because they're just worried about that credibility hit. Do they cut interest rates and then suddenly inflation takes off? But that's where we are. And it's kind of interesting. So we are waiting now on the first central bank to start actually cutting interest rates. But we had the clearest signal yet from the Bank of England today, particularly with that interview we just did with the governor, where he said a cut is now more likely than a rise. The first time he's explicitly said that. OK, thanks, Ed. Now, the Swedish car maker Volvo said today it will stop providing funding to its electric vehicle startup Polestar. Volvo, which is 79% owned by the Chinese car maker Geely, said it may even hand some or all of its shares in the business to its majority shareholder. Well, the news came as Volvo said it sold 708,716 cars during the year. That's the most in its 97-year history. Operating profits for the year, excluding joint ventures and associates, came in at 25.6 billion Swedish krona, equivalent to £1.94 billion, and that was up 43% on 2022. I've been speaking to Jim Rowan. He's the chief executive of Volvo Cars.
Actually, that's been one of the most pleasing things that we've found is we have very strong demand in pretty much every geography. In fact, the record results that we delivered this year came by way of 24 of our different sales companies managing to have record earnings. And those were global. US, Canada, we had Mexico, we had Brazil. In Europe, we had Germany, we had the UK, Poland, Switzerland, and then even in Asia, Korea and Thailand. So it was a really widespread effort, if you will, in order to reach those record results. And those the 2023 results are the best results in terms of the number of cars we've sold, the revenue, and probably perhaps more importantly, the profits. Profits up 43% year over year. But really, the big thing about that is that it sets us up for a very strong 2024, where we committed today to the markets that we expect to have another record year in terms of revenue in 2024. And that comes by way of the products that we have and I think the strong brand recognition that we see in most markets.
Obviously, the industry has been beset in recent years with issues over parts. Are all of those issues behind you now?
Yeah, pretty much. I mean, we went through some of the same trials and tribulations as many others 18 months or so ago. We got ahead of that curve quite quickly, and now we've saw the supply chain become a lot more robust. And this year, and the signals for 2024 are very good in terms of we don't expect to see those supply chain disruptions that we suffered, along with many others 18 months or 2 years ago. So yeah, it looks like we're through that particular issue.
Now, of the production figures, 16% were fully electric, which, as you say in the statement, is quite high for a legacy car maker. If we were having this conversation this time next year, what would you expect that to have risen to?
Yeah, we've not put an exact number on that, but remember, we've done that 16% basically with two car models, the XC40 and the C40. This year, we have 3 brand new electric models. That one's already been announced, the EX30, that's a small SUV. We think that'll be a high volume car. Pre-orders for that are incredibly strong. Demand for that looks great. And we have great supply on that car as well. In fact, we have over 40,000 in transit right now. Then we have the EX90 and then the EM90. So we've got 3 brand new cars which leverage on top of the XC40 and the C40. So having this conversation at the same time next year, I'd expect our percentage to be considerably higher, and that we'd be taking more market share in the premium sector at EVs.
Now, you've also announced today that you're going to stop funding Polestar. What's the thinking behind that?
Yeah, for us, that's a natural evolution. I think the relationship between Polestar and Volvo has been very, very successful. We certainly helped to incubate that as a young company, which we supported in terms of our platform technology, our research and development, our supply chains, even some of the commercial relationships. And the Polestar 2 and the Polestar 3 were built on Volvo platforms. But now Polestar moves to that next phase of their development. They go from a 1-car company to a 3-car company. The Polestar 4 and the Polestar 3 are fantastic cars. I've driven both of those cars. And so it seems natural that this would be the point that they would then spread their wings and go out and get their own funding. But of course, they're going to continue to be supported by Geely. And Geely is a much more natural holdings structure for Polestar to be within when they move to the next evolution stage in the coming years. So I think it's good for Volvo, I think it's good for Polestar, and of course we'll maintain that operational relationship that we've had with Polestar in the years past.
Some other business news stories for you now. And Shell has suffered a big drop in full-year profits following a decline in oil and gas prices. The company's adjusted earnings for 2023 came in at $28.3 billion. That was down 29% on the record performance achieved in 2022. But shares of Shell have risen by more than 1.25% after the company said it would raise its dividend to shareholders by 4%, while also pledging to buy back a further $3.5 billion worth of its shares over the next 3 months. Eyebrows have been raised, though, by news that Shell's investment in renewables fell to its lowest level since 2021. BT's new chief executive said this morning that the company was on track to hit its full-year targets after reporting better than expected sales during the final 3 months of 2023. Alison Kirkby, who replaced Philip Jansen last month, said she was looking forward to leading BT into the next phase of its development as the company reported adjusted underlying earnings of £2 billion for the 3 months to the end of December. That was up 1% on the final 3 months of 2022. BT's Openreach division was a star performer, raising sales during the quarter by 7% and underlying earnings by 11%. TSB today became the latest bank to announce a round of job cuts. The lender, which is owned by the Spanish bank Sabadell, said it had last year set aside £24.4 million for estimated employee severance costs. It said most of the roles affected would go this year. TSB did not say how many jobs would go, but it said it would involve branch closures. Well, the news from TSB, which employed 5,426 people at the end of last year, follows announcements of both Barclays and Lloyds of job losses in recent weeks. Now, Phoenix Group, the UK's biggest long-term savings and retirement business, said today it had hit its 2025 target for new business cash generation 2 years early. The company, which owns Standard Life and which manages the retirement savings of more than 12 million people, including former customers of the likes of Britannic, Pearl, Abbey Life and Scottish Mutual, said it enjoyed new business net fund flows of nearly £7 billion during 2023, up nearly 80% on the previous year. Phoenix highlighted an improved performance in Standard Life's businesses, but also strong growth in taking on the liabilities of established pension schemes from employers such as Siemens. Well, joining me now is the Chief Executive of Phoenix, Andy Briggs. Andy, good to see you this afternoon.
Good afternoon, Ian.
A cynic would say, were your 2025 targets stretching enough?
So if you go back 2 or 3 years ago, Phoenix Group was just focused on consolidating closed books of business. But what we've done over the last 3 years is really focused on investing in the Standard Life business and driving strong growth. So the 1.5 billion of new business long-term cash we announced today, the level we need to replace the runoff of that closed book business is about 800 a year. So that's a massive transformation for the group. And we're now a proper trading business that's growing strongly organically. So big transformation.
Obviously, the last year to 18 months have been pretty tough for a lot of people. Have you been surprised at the extent to which people have continued to save for their retirement?
It's actually been positive. So one of the strongest parts of our business results today was the workplace pensions business, where we saw the new business net fund flows almost double to £4.5 billion. And what's been driving that is basically the higher inflation and higher pay rises. Most of that is salary-related business, and so people are paying the higher contributions. And we haven't seen a material impact from cost of living. And I think what's going on, Ian, is that our customers are worried about cost of living, but they tend to look at their net pay and then look at the outgoings from net pay. And ultimately, workplace pensions are taken off gross pay, pre-tax, effectively. Yeah? And that's right, because it is really important, even in a tough cost of living crisis, that people are still saving for their retirement.
Now, you did some $6 billion worth of premiums in bulk purchase annuities in the year. I think that was up from 4.8 the previous year. What are you looking at this year?
So we're very balanced in our business mix. So we have 270 billion of assets we're looking after for our 12 million customers. And 2/3 of that is capital-light fee-based business, such as workplace. And so on the BPA side, it's an important market for us, but we limit the amount of capital we deploy to try and keep it to a smaller proportion of our total assets and keep it very diversified. But the outlook for the year ahead is very positive. With higher interest rates, basically more finance directors can afford to buy out these liabilities. And I've never met a finance director in any sector that's pleased to have it. If you're in retail or services or telecommunications, any of the companies you're just talking about, they would love to offload these liabilities if they can. And with higher interest rates, it's more affordable.
You've been quite disciplined, though, in the business that you write in this part of the operation.
Yeah, very much so. A number of our competitors basically just focus on BPAs. Our focus is we want to help customers on that journey to and through retirement. And there are 3 parts to that. Help them save more through the workplace. That's the main saving place, workplace pensions. Yes, we want to help those with defined benefit pensions to get the income in retirement. And the third element is to help people sort of age 50 plus, where they have multiple pension pots, to consolidate those pension pots and develop a plan into retirement income. So we want to play across that whole spectrum, helping people on the journey to and through retirement.
And one of the things that the government was hoping to do to that end was set up a pensions dashboard. It feels as elusive as ever.
Yeah, it's really important, though, that we get there on that, because people do have these multiple pension pots from each of the employments that they have. And the admin job is just daunting for customers to try and bring it all together. So as an industry, we do need to come together and bring that about to make it easy for customers to see what different pension pots they have where, and then they can develop a plan of how they're thinking about rolling that over into retirement income.
Now, you talked an awful lot about new business here. The origins of Phoenix Group are, of course, with closed book policies. Are you still looking for targets there?
Very much so. So M&A remains a core part of our strategy. We think there's real benefit for customers and shareholders in consolidating businesses. It's something we're really good at. So it remains a core part of the strategy. And of course, last year we did buy a back book. We bought Sun Life of Canada UK. It was our first cash-funded transaction that we completed in April of last year. So it remains a core part of the agenda. But what's great for us now, Ian, is historically, when we just had closed books, we had to do M&A in order to keep the business moving forward. Now we're growing strongly organically, it becomes an extra boost on top, but nice to have that organic growth.
All right, Andy, busy day for you. Do appreciate you spending a few moments to speak to us. Thank you.
Good to see you.
Still to come here on Business Live, we'll have a look at how the markets have done this afternoon. Don't go away.
It's always difficult at this time of year when you walk out on a train station, for example, and it's freezing cold and you can't think forward. But we've been there before. A couple of years ago, 40.3 was the top, and everybody else 37, 38. So, look, it's a silent killer. That's what this committee.
Silent killer?
Simply because when these things are reported, they're not reported you died of when people die of of heat. It's not reported you die of heat. It's reported you die of a stroke or a heart attack or other symptoms that go with hot weather. And hot weather does kill as much as cold weather kills. So weather is massively underestimated. And I'm really glad that this committee have got some. Whether they've got teeth is another matter, but at least they brought it to the attention. And also the fact that you are actually reporting it on Sky News, because, it's almost like a silent story. It doesn't get out there. It doesn't resonate. I think they've got to put this into schools, colleges and the broader spectrum of society to make them understand, make people understand that weather per se, whether we're talking storms, we're talking cold, hot, understand that when you see these extremes of temperature, these extremes of weather, that we have to act accordingly. So what we do, I could be here for a day and a half, but the point is we've got to move in that direction. So people have got the knowledge to help themselves first, help their families first. So a really easy one would be, for example, painting roofs white. Why? Because it reflects the heat in the summertime. When you get that excessive heat and you touch a white surface, it's very different than touching a black surface.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Well, the pound had been trading lower before the Bank of England interest rate decision at lunchtime, but the Governor Andrew Bailey's downplaying of early interest rate cuts and news that 2 MPC members voted to raise rates helped it claw back those earlier losses. As you can see, sterling currently trading up 0.25% against the US dollar. It's about 1/6 of 1% lower against the euro right now. The single currency, meanwhile, up by just over 1/3 of 1% against the dollar. On the equity markets, European stocks have all finished to the downside this afternoon. There are lots of European companies reporting their results today. In terms of some of the big movers, the drug maker Roche fell by 5% in Zurich and its peer Sanofi by 4% in Paris as their updates disappointed. To the upside, Deutsche Bank finished ahead nearly 3% in Frankfurt. That was on news of a €1 billion return of capital to investors. Well, here in London, the FTSE 100 also finished in negative territory, off just over 0.1%. Some of the big overseas currency owners have been weighing on the index. It would, in fact, have been even worse had Shell not added 15 points to the index. Their results being well received today. Big heavyweight company. In percentage terms, well, 3i, yesterday's biggest percentage gainer, was today's biggest percentage faller. That finished 5% lower following a performance update. Elsewhere, outside the FTSE 100, the paving slab manufacturer Marshalls, that's up 4% on positive broker comment. Over on Wall Street, the S&P 500 and the Nasdaq have opened to the upside after yesterday's sell-offs. Alphabet and Microsoft have both rallied by 1.5%, also following Wednesday's falls. All eyes, of course, on results after the closing bell tonight from Apple, Amazon and Meta. As for the oil price, well, that sold off overnight, rallied this morning, and now it's a bit, it's held on to most of those gains. Looking at that now, a barrel of Brent crude currently changing hands at $81.40 a barrel. That's up a little over 1%. Now, some 224,000 Americans registered for state unemployment benefits for the first time in the last week, the highest for 2 months, in a sign that the US labour market is continuing to cool. Well, the news comes ahead of tomorrow's non-farm payrolls data, a measure of the number of people employed in the world's biggest economy and usually the most watched data release of the month so far as financial markets are concerned. Well, Wall Street's expecting the figures to show that 180,000 jobs were added in January. Well, joining me now to talk about this is Nela Richardson, Chief Economist at the US human management technology company ADP. Nela, great to see you. I mean, that was quite a big jump in the weekly's jobless claims, wasn't it?
It's a jump, but it's important to keep it in perspective. Now, averaging before the pandemic, those jobless claims were about 240,000, and unemployment was still very low. We're still at below 4% unemployment in the United States. That's not expected to pick up tomorrow. So it's a number, it's a small jump. These numbers are very volatile. I wouldn't call it a trend yet, though.
Yeah, I mean, what's really interesting, though, is that, I mean, a lot of US employers do seem to be hoarding labour. They don't want to let people go.
That's because it was so hard to get them back. Now, remember, in the United States, we lost about 20 million jobs in 6 weeks. And it took over a year and a half to get those workers back up to levels that they were before the pandemic. So it was a hard slog for US-based companies of all sizes. Now that they have workers, now that we've reached employment, especially for women, near record levels, they are reluctant to let them go, just as you said.
So which are the sectors where you're seeing there's real tightness in the labour market? I mean, I imagine tech is one of them.
Actually, no. We're
No?
not seeing as much. In fact, tech is one of those places that were really untouched by the pandemic. You can do that job remotely. And what we've seen is that companies maybe overextended in terms of tech. When the economy was shut down and everybody was ordering smoothies online, the digital economy really came to the fore. Lots of hiring in tech. And now we're seeing maybe companies right-sizing that hiring. What's really seeing shortages or things like vocational skills that are needed, like plumbers, electricians, even accountants, those skilled professions, nurses, teachers, the care economy. And so these are places that have a longer-term shortage that has yet to be filled by the present labor market.
So those are some big chunks in the US economy that you've reeled off yet there. Why is it in that case that wage inflation isn't running hotter? I mean, it feels as though wage inflation has kind of peaked.
Because it's where the wages are. We kind of talk about wage inflation like it's one thing and everybody feels it, but that's actually not the case. Where we saw the fastest wage growth in the United States is for low-skilled, low-income work. Those workers that were most affected by the pandemic in restaurants and bars and retail, in-person jobs where you really needed to be in contact, they lost their jobs. And so it was all about getting those people back in the labor market. And now that they are back, wages are starting to moderate for this segment of workers. But remember, wages were growing at double digits from a very low base.
Indeed, yeah. What do you hear from employers in the US about the quality of school and college leavers right now? Is the education system equipping them for the world of work adequately?
Oh, that's a great question. I think there is improvements to be made, especially in skilled trades and vocational work. College education is great. I'm an advocate. I have a freshman in college right now, but it's not for everyone. And you could have a career. You can even own your own business, be an entrepreneur as a plumber or an electrician. And I think that having that avenue, increasing the availability of skilled work is important. And another trend we're seeing among large companies is skill-based hiring. Hiring not because of your degree, but the skills that you acquire and maybe training workers in the skills that you need. That increases loyalty and longevity of your workforce. So it's a win-win.
Very briefly, you mentioned there you didn't expect to see much drama around the non-farm payrolls figures tomorrow. The Fed obviously last night set its face against an early rate cut. What would they need to see tomorrow to change their thinking, briefly?
For a rate cut?
Yeah.
I don't think there's anything we'll see tomorrow that will lead to a rate cut in March.
Okay.
What we're seeing in the labor market at ADP, and we actually pay about 20% of the U.S. workforce, so our data is a pretty good indicator of what's going on, is that the labor market is cooling, hiring is slowing, but it's still solid. So for the Fed to move on a rate cut, they would have to see, unfortunately, some trouble in the U.S. economy, and we've been seeing solid growth instead.
Okay, Nela, got to leave it there. Good to see you today. Thank you. That's it from me. Mark Austin's up next with the News Hour. Stay tuned. Cheerio.